overhangs continue for HDFC Bank and still under pressure. 734 thereabouts is where that stock is. Ankur, thanks for those details. Let me now welcome on board Joseph Anantaraju, the co-chairman and CEO at Happiest Minds, and also Venkatraman Narayanan, the MD, joining in on the show right now to talk about how their quarterly performance was. Narayanan, hi, morning. If I could start off with you, with your numbers largely in line, how was Q1 versus your own internal estimates, and has it been a good start to the year?
Well, it's been a very good quarter. Let me start by not being sheepish about that. Revenues have grown 14.3% year over year, and I'll take you directly down to our adjusted PAT. That's also grown by a similar number, 14.7% year over year. The interesting point is our adjusted EPS also stands at about ₹5.34. Annualized, that's close to 21 rupees. So it's been an all-round good performance. Revenue growth, the headcount has slightly increased, utilization has stayed consistent, while also improving on all our return metrics on the shareholder front. We have started the year on a good footing, looking to see how we can meet our guidance number. In dollar terms, we have set 12.5% for the year. So that's something that we are consistently focused on. There are changes in the market which we need to take cognizance of, but still trying to push to reach that number for the year. At the same time, at the operating margin level, we said we'll do between 17 to 18.5%. We are maintaining that at about 17.5%, despite some one-time costs that we have taken in this quarter, adjusted for which we would have been much ahead at about 19%. So if you look at it, a good quarter, a good start for the year.
Morning, Joseph. You've been able to get a CC growth of roughly around 2.9% in the first quarter. Do you think the momentum will sustain?
Sure. So as you rightly pointed out, Venkat mentioned, we've had a very strong quarter. INR growth of 4% and constant currency growth of 2.9%. All things to feel good about, a good way to start the quarter. And this growth has been, if you look at our verticals, this growth has been driven across verticals, barring maybe manufacturing and a small dip in TME. All other verticals have grown quite well. You had HCLS leading the way with 9 to 10% growth. You also had high-tech growing quite well with 10%. BFSI has contributed. Retail also inched up a little bit. And if you look at it from a geo perspective, I think the growth was led and driven by three geos. India, which continues to do well for us. We've always stated that India is a market that we are focused on. It contributes 19% of our revenues, among the highest, if you look at other IT services companies. Again, APAC on the back of a couple of large customers, growth in a couple of large customers, and Middle East, where we have two anchor customers that contributed to growth. So overall, I think the stage has been set. Pipeline also, continues to look strong and promising, which portends well for Q2.
And lastly, then, does your earlier guidance of 12.5% constant currency growth in FY27 remain intact?
That's right. We are holding on to that right now. Early days, I should say. When you compare, you have to look at our year-over-year constant currency growth, which is at about 6.9 to 7%. So the task out there is, to get that growth in the subsequent quarters to make sure that we are able to touch that number. But yes, like I said, it's a guidance, and we all efforts are on all hands on the deck to meet those.
All right, gentlemen, great to be speaking with you. Thank you so much for your time. Happiest Minds maintaining their guidance and stock holding up 1%. But the big high flyer today is also Tata Power. The operational updates look extremely strong, while of course the ballpark numbers have managed to beat the street estimates. But it's the highest ever quarterly Capex that they've outlaid. The renewable portfolio has expanded now to 12 gigawatt. And the Mundra plant as well resumed full operations under Section 11 in the quarter gone by. So let me welcome on board Praveer Sinha, the CEO and MD, and chat about what the quarter was and what's the visibility looking like going ahead. Praveer, great to have you on ET Now. Thank you so much for your time, and congratulations firstly on reporting this 11% year-on-year increase in your profits this quarter. Tell me, what were the biggest drivers behind this kind of growth, and do you expect them to remain sustainable going forward?
Good morning. Thank you for having me on your show. You're right that this quarter has been phenomenal, but I think this is the 27th consecutive quarter in which we have shown growth in revenue and PAT. So I think it's on back of very consistent performance of all our businesses. Some are doing exceedingly well, but all of them are doing well. Our existing generation business, conventional coal and gas and hydro have done exceedingly well. We've shown a growth of nearly 16%. Similarly, transmission and distribution has shown a very good growth of, again, 15%. And renewable is 20% growth compared to last year's similar quarter. So I think there has been a consistent performance. And what we are seeing is that with more capacity adds that is happening, and typically the first quarter is little muted compared to the subsequent quarter, we will see more than 4 to 4.5 times of every of these parameters on revenue, EBITDA and PAT. So you can expect a very good year from Tata Power in FY27, and consistent performance you will see right across all quarters.
You know what the street is most charged up about is this highest ever quarterly Capex that you've announced, and a sizable one at that as well. Tell me, how will this capital be deployed, and how comfortable are you with the company's current debt profile?
So this quarter, it is the highest Capex that we have done, and that demonstrates that now all our projects, especially the utility scale renewable projects, are getting implemented very fast. We earlier used to do a lot of third-party projects. Now we are doing everything in-house. So this year we have a plan to set up nearly 2.5 to 2.7 gigawatt of renewable projects. We also have a huge Capex happening in our distribution business, transmission business, including the Mumbai transmission. And while we used to do earlier about 500, 600 crores in Mumbai transmission, this year we'll do about 1,500 crores. So I think generally you would come across very good performance from all our businesses, and they will start again. The benefit of that will start showing in the next 6 months when we have some of these projects commissioned, and their revenue and impact on PAT and EBITDA will be seen. So I think you will see very consistent performance from Tata Power going forward.
Hi, good morning, Sajid here. You operationalize your pump storage power project as well in this quarter or then last month as well. Can you give us a sense of the kind of timeline that you have for the pump storage portfolio for yourself?
So the first 1,000 megawatt is under implementation. We do expect that this will start showing results when the plant gets commissioned in early part of 29, calendar year 29. And the second one, the 1,800 megawatt, we expect later part of this year, the work to start, and that will get commissioned by 2031. So I think these will be very strong storage projects. We already got the first win in the SECI bid, very good tariff that we have been able to win in that. And I do expect that the similar trend you would see in the subsequent bids that will come up, which we are expecting in the next 6 to 9 months.
Sinha, if you can also give us a sense of the solar manufacturing profits as well, from that point of view, how do you see the scale up happening? As you move towards 10 gigawatt of ingot and wafer facility, how sustainable is this growth? What kind of investments you will need further to bring up that capacity?
So our manufacturing plant, the cell and module 4.3 gigawatt, is working at full capacity. We produced more than 1 gigawatt in one quarter. And I think this will continue in future because the optimization that we are doing in that is helping us to improve the performance, both in terms of yield efficiency and also optimization in cost. And you would see that our PAT for the manufacturing has gone up more than 2 times in this quarter compared to last year's similar period. And this is on back of excellent cost optimization efforts and production efforts. Expect the 10 gigawatt of we've got plant the work to start in October and commission first quarter of calendar FY27, 28. And we are on track to again implement excellent state-of-the-art plant, which will start producing wafers and ingots, which is the raw material for our cell plant.
I also want to talk about Mundra because that resumed full operations under Section 11. Tell me, how much did this contribute to Q1 performance and what is the long-term strategy now for the plant?
So Mundra is now working on the SPPA. Though the operation is under Section 11, the tariff is under SPPA to all the procurers. What we expect is that we will be quits in this. We will not make any loss or any profit in this. Last year, we made a loss of nearly 1,100 crores. So that's the benefit of this project because it will be on a cost reflective tariff and it should be able to sustain its operation without incurring any further loss.
Sinha, congratulations once again and thank you for your time today. Good speaking with you.
Thank you. Thank you very much.
Well, that's Tata Power management, extremely confident, but the one that's not is Unilever. Now, this really is turning out to be a tale of two sides of a coin, really. While you look at if you look at the quarterly performance right now, that has fallen short of expectations on pretty much all parameters, especially the big disappointment and the big crack that you're seeing on the stock is because the volumes have come in much lower than what the street was anticipating. The other side of the story is that, the guidance that they have actually, talked about, which is what actually is the reason that you've seen that little bit of a recovery actually play out on the stock price as well. But I'll tell you what, I'm going to quickly take it across to Harsh and analyze that while operationally, Harsh, the numbers haven't met expectations, but the guidance has still been maintained.
Guidance maintained. The guidance was that they'll operate in a 22.5 to 23.5% kind of EBITDA margin band. It's come in at the lower end of that band at 22.8%. That margin number has disappointed. And as a result of that, what we're seeing that knock on the stock. The EBITDA absolute number has come in roughly 5% lower. Volume growth hasn't come through. The overall volume growth was expected at 6% on a YOY basis. It's come in at 5%, which is a bit of a disappointment, right? Because in any case, the base or the expectation was quite low. And that has also disappointed. You've seen top line growth also being marginally softer than expectations on the back of that slightly softer volume number. And because of the operationally weak performance, what we're seeing that miss on profitability, very evidently so. So broadly, that's how we're set up where HUL is concerned. I'll go into the specifics. Home care, the sales growth has come in at roughly 14% odd. High single-digit growth in terms of volumes is what home care has clocked for this quarter. Beauty and well-being at 12% in terms of sales growth has come in slightly softer than expectations. High single-digit growth, again, is what they've clocked in terms of volumes there. Personal care is where the softness in the numbers is evident, 4% on sales and low single-digit decline on volumes. That's where the volume has actually come off. And what we've seen is on the food side, sales growth is at 7% and volume growth is mid-single digit. So broadly, that's the texture. Let me go across to Kaustubh. Kaustubh, how are you reading into the numbers? What was the single biggest miss? Let's start with that, Kaustubh.
I think the biggest miss for us was the margins, because we were expecting somewhere around 23.5% kind of EBITDA margins, and it came at around 22.8%. So that was a miss. On volume side, we were expecting around 6.5% volume growth. Volume growth came at 5%. So these were the two factors where the miss was there in terms of our internal estimates. But overall, if we look sequentially, the revenue growth has improved. But I think unless and until they don't see any significant improvement in two of their categories, that is personal care and food business, I think the growth would be gradual for HUL in the quarters ahead.
What's led to the margin miss? Raw material prices were expected to be elevated, but at 22.8%, the margins have come in far weaker than us building in the higher raw material prices into the estimates as well. What is your sense? Of course, it's still initial minutes of the results, but what's your sense? What's led to that miss on the margin front?
The gross margins are down by 80 bps. Okay, so that was on the anticipate lines. But even if we looked at some of the other cost element, advertisement spends, though they are lower on YY basis, they are broadly maintained in that range of 9.5 to 9.6%. And also on the other expense side, it is purely on the operating leverage play. So basically, if you revenue growth and volume growth improves, I think that will flow into the margins. But here, this quarter, there was a volatility in the raw material prices, and that had an impact on the margins. But I think going ahead, if your revenue growth momentum improves and raw material prices stabilizes, I think we should expect those EBITDA margins coming back to the guided range. So that is not an issue. The important point over here is the recovery in the volume growth. So if we compare with some of the other FMCG companies, especially the food companies, they are delivering much better volume growth. But for a company like HUL, I think in some of the categories, they have missed on the volume side. And if we see improvement in the volume of those categories, I think things should come back on track for HUL going ahead.
And Kaustubh, in terms of the growth itself, within all the verticals, what's really disappointed in terms of the growth number?
I think personal care, where they still are lagging in terms of growth. Personal care and food, these two are the main categories where they are lagging on the growth front. I think they are pretty good on the home care and beauty and well-being category, because there they have maintained the volume growth momentum.
Today on the show, thank you so much for analyzing Unilever's performance. Harsh, let you go as well on that note. We'll take a very quick break. We'll chat with the Orient Pro management on the other side.
Welcome back. You're watching The Market, and we have with us now Ashish Rai, who's the Group CEO of Orient Pro Solutions. Ashish, hi. You've been able to get us a good quarter-on-quarter revenue growth of 3.6%. How do you look at the revenue potential for the FY27, and what are the key execution tailwinds that you have going into the rest of the year?
Hi, good morning. Thanks for having me, first of all. Great question. We faced a set of challenges in Q4, which we came on your channel and we talked about, and we said we'll execute against it. It's great. Sequentially, you're right. We grew 3.6%. It's great to get the business back into growth, and we hope to power through the next few quarters. We said we will do a few things. In terms of one, refocusing on the set of businesses where we see demand, defocusing a little bit on the Middle East, where we saw some challenges last quarter, and I think it's still not fully come back. And we said, so the banking software side will focus on new markets, which we've done. Double down on data center side, which we've done, and we've announced some very strong order wins. They have to obviously convert in terms of revenue through the year, but that should happen over the next few quarters. And we see fairly strong traction in terms of both the pipeline getting built up and the order book getting built up, right? So I think the focus would be now to sort of just take this getting back to growth in Q1 and now power through the rest of the year and keep focusing on execution.
But Ashish, what about the demand environment per se, and especially in the Middle East? How's that holding out?
Yeah, so Aisha, thanks. The Middle East is I don't think you can say it's fully back to normal, right? But I think for us as a business, because we got a little bit too dependent on that side, I'm pretty sure it will come back. But we've pivoted away, at least from a sales focus standpoint, into other markets, and we are seeing success, in terms of really pushing the transaction banking stack, for example, in Southeast Asia, and on the data center side, transit side. So I think Middle East, I think will probably take some time to get back to normal, as we all know. But from a business standpoint, I think we've successfully sort of refocused, and whatever impact there is from it, I think by Q3 that will get normalized out anyways, right? So I think overall, the demand environment for each of the businesses, whether that's the AI native stack on the banking software side, whether it's the data center side where demand is really through the roof, as well as transit business going increasingly global, I think the demand environment seems pretty strong. We have to keep executing against it.
Ashish, I was looking at your margins. It's fallen 300 bips on a year-to-year basis and over 210 bips on a quarter-to-quarter basis. What's the game plan to bring back the margins?
Yeah, so some of it, I think, like we explained again in last quarter, so it's a bit of refocusing the business. Margin is a function of the business mix, as well as a function of the investments which we are expensing out right now for various reasons. As we all know, we're going through one of the most fundamental shifts that the technology business has seen, and we've really doubled down in terms of rolling out an AI native stack across the entire Orient Pro sort of software stack. So which means, for a couple of quarters, like we messaged, the investment on that side would remain elevated, but we are passing through a window of time where the opportunity for us is so large that it will be almost unfair to not invest against it. And the second part is the business mix again, which will change quarter to quarter, right? So I think we are going through a period of time where, as we messaged, we will have investment that will need to go in over the next few quarters, and slowly I think the margin will normalize with the business mix.
Right.
When do you expect investments in AI data center and platform capabilities to start contributing meaningfully to the profitability?
Yeah, so it's already contributing. Like, it's a question of business sort of growing over the next several years, right? Because these are multi-year cycles. I think every single part of it now is, whether it's the enterprise AI stack, whether it's the software stack, which has a lot of AI native components built into it, whether that's the data center space, which is again largely AI driven. I think each of these spaces, you already see a lot of meaningful contribution from the investments coming in. But the game is not to really, sort of show one quarter to the next, what exactly that is. But the idea is, can we get to a position of leadership in each of these spaces? Can we be really a top quality full stack partner for hyperscalers who are sort of setting up capacity in India? I think we're already becoming that. Can we be a top tier partner for AI native software for banking? I think we're already becoming that. And I think over the next few years, the results of most of these investments will show a lot more strongly. I think it's not that it doesn't show right now. So if you see Q1, the size of Q1 was what the size of the whole business was probably 4 or 5 years back, right? So, obviously the business has grown very strongly, and a lot of it is thanks to a lot of investments we've made around IP and products. But the goal is to build out a global products and platform player that can take a position of leadership in these spaces. And I think that goal, we will progressively keep stepping towards.
And Ashish, what's the implementation timeline now, specifically when it comes to your large banking wins?
Yeah, so actually, I think the timeline-wise, it sort of, it's not changed a lot, but it's changed a little bit. And I think that sort of varies with geography. So we saw extended timelines in the Middle East, which resulted in obviously delay in execution as well as delay in converting the order book to revenue, which honestly is the big challenge that we're trying to solve for right now. The order book is very strong, but how does the revenue conversion get accelerated? The second is, again, in some of the spaces like data center, we need to build the capacity to convert that revenue, which again, we've been working very, very strongly on. And I think honestly, the team has done a fantastic job of scaling up to sort of try to keep pace with it. I think implementation cycles get stretched a little bit. Middle East, it got stretched a bit more. And also because of the AI cycles coming in, sort of the scale of implementation that we are doing is slightly larger than what we used to do, right? So I think that probably stretches it maybe 10, 20%. So all the factors together, I think there is intense focus that we have as a business now on revenue conversion from the order book. So you'll see that progressively over the next couple of quarters, we'll hopefully be able to bring the implementation timelines down across the business in a few places.
Ashish, can you give us a sense of the the banking wins that you got this quarter? What is the kind of implementation timeline that you have, and how quickly they will start contributing to the revenues?
I think start contributing pretty quickly. Typically, I would say if you look at a banking project, the implementation timelines are 12 to 14 months. I think what we've announced over Q4 and Q1 will convert into revenue within this year. And then as we win, I would say a chunk of it will get converted, right? So it starts converting to revenue pretty quickly, especially license gets consumed immediately straight away at the time that we start the implementation. And then, typically implementation projects are 12, 14 months, and that will play out as it plays out.
Right. Okay, great. Ashish, good to speak with you. And thanks for your time as always.
Thank you.
Well, that's the management of Orient Pro talking about, while it has been a little bit of a mixed bag, their quarterly performance, but going ahead, things are looking up. But on that note, we're completely timed out in this edition of the Market in First Trades. It's a goodbye from Sajeev and me. And we've got Midcap Masala coming up next.
Hello and a warm welcome. You've joined us on Midcap Masala right here on ET Now. I'm Ashesha Advaryu. You've joined us on our ET Now Suzlon studio. And this is a show where we discuss all the midcaps that are in focus today. But first up, let's take you through all the top headlines that we're tracking at this hour. RR Kabel rallies after reporting strong earnings beat with robust growth across revenue, profitability and margins. The company also announced that its FMEG business has achieved break-even, marking an important milestone for its consumer products business. And Coforge, meanwhile, is in focus after reporting strong revenue growth that exceeded expectations, driven by continued business momentum. However, margins softened and profit declined sequentially, reflecting higher costs during the quarter gone by. The stock is up a whopping 9% in trade today. Shifting focus to Godfrey Phillips, then the stock is declining in trade, now down 6.5% after reporting weak quarterly performance with a sharp decline in profit and margin contraction. Management said it is following a balanced pricing strategy with price hikes being passed on to consumers in a phased manner. Gallant Ispat, meanwhile, from the metals pack is also in focus and the stock is locked in upper circuit of 5% after reporting its quarterly performance, with profitability meanwhile coming under pressure despite very stable revenue growth that the company reported in the quarter gone by. The stock is up 5% in trade today. Orient Pro Solutions, meanwhile, is trading lower. The stock, in fact, is down more than 11% in trade after reporting muted operational performance as project timing shifts, supply chain disruptions and geopolitical issues in the Middle East and Africa impacted their revenue conversion. The company also saw margin contraction due to higher input costs during the quarter, and that is exactly why the stock continues to remain under pressure. But shifting focus then, let's put the spotlight on Dodla Dairy. Then this counter reported its numbers, and very strong set of numbers that the company has reported. Although margins have come in weaker as compared to street expectations, and even when we compare on a year-on-year basis, margins have been weaker. But the management, of course, believes that we will see recovery in margins in the next few quarters. To discuss that in greater detail, we are now joined by the managing director of the company, Mr. Sunil Reddy, who is now joining us. Mr. Reddy, thank you so much for taking your time out and joining us here on ET Now. And first of all, congratulations on reporting very strong set of numbers that you've reported for the first quarter. Volume growth has been very strong and the share of revenue from value-added products also aided the numbers. But how much of this volume growth is sustainable in the next few quarters? If you can help us with that number.
Good morning and thank you for having me on your show. Coming to our numbers, I think the volume numbers will not be in terms of this kind of a growth because last quarter-on-quarter comparison, last quarter we had more monsoons during the summer and this year the summers were extended. Therefore, we saw extraordinarily large offtake. But as per our guidance, we are still confident that we will achieve the 10% growth in volume and 15% growth in value for the whole year. This will be with the help of all the three things that we have. That's the new acquisition we have done in the east of India, Africa and India put together. We are very confident we'll achieve this number of 10% volume growth compared to the previous year.
Okay, so 10% volume growth is pretty much achievable in FY27. That's the word coming in. Although the numbers were very good, one concern for the street was margins because they have declined from about 8.2% same time last year to about 5.4% now. And one of the reasons is elevated milk procurement costs and higher packaging, transportation and fuel expenses. How soon could the margins recover and what will the triggers be? Will price hike be one of the reasons?
Yes, ma'am. Predominantly, we were waiting to see if the monsoons would be set in and if will the milk procurement prices come down with higher available milk. But I think the El Nino effect taking place, that doesn't seem like to happen. If it does not happen, we have already started taking corrective action in terms of increasing passing on the prices to the customer. It is more done in a phased manner and we will recover our margins because we will have to pass on to the customer the increased prices.
Okay, so the margins will recover in the coming quarters and you are telling us that you will be passing on the impact of higher raw material prices. How much will the price hike be? How much price hike have you already taken in the last 1 or 2 months? And how much more will be required to get back to that margin trajectory?
I think we should be taking into consideration, I think our procurement prices actually went up by 10%. And we had already taken around 2.5% price increases, done a lot of the corrections. Therefore, our effective EBITDA margin, only content margins that we were in the previous year, we will maintain those margins.
Okay, so by undertaking the price hike, you're telling us that 7 to 8% margin guidance will be maintained. But raw procurement cost, that's the raw material cost for you, has also risen exponentially in the last few months. Do you think that will perhaps normalize in the next few quarters?
That's basically, we were thinking that, and that's why we didn't pass on the prices in the first quarter, saying that if it normalizes, we will continue with the procurement prices. It's very difficult to say. It's like the El Nino that all of us know about. And we are seeing that certain areas, the weather has been playing truant and there is a deficiency of rainfall. If that happens, we don't think that the procurement prices will come down, but they will maintain the same levels.
Okay, so procurement prices might maintain at the same level, if not decline. Let's also talk about the value-added product segment, and that is a strong margin accretive business for you. And you also reported very strong growth of 41% on a year-on-year basis as far as the value-added product segment is concerned. How much growth could we expect in the next few quarters for this particular segment?
See, normally we give guidance that overall we will grow by 2%, 3% as an absolute with the revenue that we have. On a quarter-on-quarter basis, the last quarter this year and the last quarter previous year, the difference you see, like I was explaining earlier, last year the quarter was more muted because of monsoons being earlier and the summer not being so severe. And this year the summers being more extended, all our value-added products in terms of the fermented products like lassi, buttermilk, ice creams, and all these have taken significantly moved up. But we are seeing that they're not dropping down as much as we normally see once the monsoons set in. And if the monsoons continue to be weaker, this year we might see stronger traction in the value-added products going up by 3-4%. But it will be offset by the previous years. We did have a bit of volume of ghee sales, which was this year will be muted. So I think we will net off of that and we can expect an average of 3 to 4% increase overall in terms of the value added.
Okay, so 3 to 4% increase in the value-added products, but as a percentage of your total pie, value-added products now contribute about 35% of your total sales. How is the mix expected to change going forward? I'm sure you're focusing more on the value-added product segment. Will this 35% then increase gradually? And if yes, how much?
So in the years to come, this will increase over the 1-2%, but it will taper off at a point of view because it's as good as what the household views eats the dairy pie. How much of milk is in the dairy pie and respective value-added products like curd, paneer, and the other products coming in. What we are seeing is that the consumption patterns are changing with the protein fat coming in. People are beginning to eat more paneer in the south, and if any such products take off a little more, then we can see larger percentage of the overall pie. But otherwise, it will be growing in the steady pace of 2 to 3% a year.
Understood. And how much incrementally is the value-added product segment more margin accretive as compared to the other segments? I'm sure margins for value-added products are higher as compared to the other segments. What is the difference?
Basically, milk and what we call as non-milk is the value-added products, which includes dahi as a major earnings. So normally the value accretion should be between 4 to 5% compared to milk.
Okay, let's also talk about your Africa business. I do understand that it's still small as compared to the total consolidated numbers, but it remains a major growth engine driver for you. What is the outlook on the Africa business?
Africa business has always been a very value-added business for us in terms of the return on capital is extremely large and the profitability is also very large. So we are looking at around a 600 crore revenue this year coming from Africa and maintaining a 12 to 15% kind of EBITDA margin in Africa.
Okay, so 600 crore revenue expected from Africa business this year. What about your expansion projects back home in India? I believe you have some in Maharashtra, others in Bihar as well. What are those and what will they be used for?
Maharashtra is basically a balancing plant for us in terms of our procurement, and also we're selling, when we mean Maharashtra, we're extending it from the borders of Hyderabad and going into Maharashtra. So it will be Sholapur and the surrounding areas that we will be selling products like milk, curd and other products that we make. But Maharashtra will also be a large powder facility with 65 tons of powder manufacturing facility available. So we're planning to make Maharashtra a 10 lakh liter per day operation for us. In Bihar, we had acquired Osam Dairy, which had 3 plants, one in Ranchi, one in near Patna, and one in Chandil. We also are trying to revamp the Chandil plant so that it can take on more products like flavored milk and yogurt for the markets there and the surrounding markets, which also enter into West Bengal. That is the thing that we'll be revamping the Chandil plant. And we had also had some land allotted to us. We are now looking at how to make use of that land, whether we should delay that land and use Chandil more than using the land that we have got already allotted to us.
Understood. So that's as far as the capacity expansion plans are concerned, both in Maharashtra as well as Bihar. And the international business, including the Africa business, is doing very well for the company. Thank you for taking your time out and joining us here in ET Now and sharing your thoughts not only for this year, but even with respect to the coming years and the margin outlook for the company. Thank you for joining us today.
Thank you, ma'am.
On that note, we need to slip into a very short break, but more news and updates will continue on the other side, and we'll touch base with the management of Balaji Amines after this very short break. Stay tuned. Welcome back. You're still tuned into Midcap Masala, and as promised, let's put the spotlight on Balaji Amines. We now have the managing director of the company, Mr. D. Ram Reddy, now joining us. Mr. Reddy, morning. Shesha this side. Thank you for taking your time out and joining us here in ET Now. And very strong set of numbers is what you've reported for the quarter gone by. Revenues have risen by a solid 27%. In fact, I was just going through the bottom line. It has nearly doubled on a year-on-year basis. What led to this kind of growth, and how much of this is sustainable as we head into the second and the third quarter?
This is definitely, as I said in my earlier interviews also, 22 to 24 is definitely sustainable for our type of industry, specifically for specialty chemicals and other chemicals. And here it is about 26% because of our integrated facilities and import substitute portfolio. So we could do this. In spite of disturbance in the Western Asia, we could do this. Even though there was some volumes are down. If you see the year-on-year basis, some volumes are down because of the logistics, even for the inward and outward for the international market logistics are disrupted. The reason we could not do the volumes. If the volumes are done, then we would have been come with a better results than what we have done now.
Okay, so those are several factors which were at play in the first quarter. But FY27 guidance that you had shared at the end of last quarter suggested a 10 to 15% volume growth along with the margins in the range of 22 to 23%. How does this guidance for the full year change basis the numbers that you've reported for the first quarter?
Definitely, it's a coming quarter. I'll tell you, there are the 3-4 new things are happening. One is the DME we just launched. And sampling is going on. Probably from the coming month onwards, you will see the results of uptake for the dimethyl ether, which is alternate for the LPG. And along with that, the acetonitrile new plant with a higher capacity and with the new technology will be coming online from the next month. Maybe by 20th of August onwards, we'll be in the market for the selling the acetonitrile. And third, there's a plant called NMM that is also scheduled for the next month. Along with this, in that our subsidiary side, hydrogen cyanide, sodium cyanide, and EDTA derivatives, these are all lined up to come in by the end of the fourth quarter. Mid of the fourth quarter, those are also launching. So going forward, we will see all new products coming in, even though the difficulties the Western Asia, I feel that we should catch up those values what we lost in this quarter in the coming 2 quarters.
I understand that there are several products lined up, but does that mean that your guidance remains intact?
Definitely. I feel that definitely we should be reaching the values, what I said, 10 to 15%. Because the product launch DME, it has not gone to the market. We are just doing the sampling to the various customers in the propellant market and all other markets.
And what will the incremental revenue be from this DME that you're talking about? I believe it has now been commercialized. It has not reached the market is what you're telling us. But what will the incremental revenue generation be from this new product?
See, definitely there will be 10 to 12% revenue increase will be there. Because this being a first year, we cannot expect that it will go into 100% capacity. But definitely in the next year, you will see the almost 200 crores minimum revenue from this plant, addition to the existing.
Okay, so that's the incremental revenue that you are expecting from this. Let's also talk about your subsidiary, Balaji Specialty Chemicals. It has now turned profitable and it also has a 750 crore expansion plan. And I believe last time you did tell your investors that the IPO has been deferred until the expanded portfolio is commercialized. Is it now the right time to perhaps unlock value for shareholders by listing this subsidiary of yours?
Too early to say, but yes, definitely there are 2 things are happening in that. Number one is the brownfield modifications in the plant for the manufacture of the value addition products like Tata, triethyl triamine, and TEPA, which are coming first time in the country. Countries importing these products about 3,000 to 4,000 tons. We will be launching this in the coming 2 months, and along with that, the greenfield expansion of the 600 to 700 crores, that cyanide derivatives, and also EDA derivatives like EDTA and EDTA NA, all these products will be coming in the pipeline from the last quarter of the current financial year.
Okay, so that's as far as the listing of the subsidiary is concerned. You did talk about your FY27 guidance, 10 to 15% volume growth intact. What about FY28 then? I believe 3,000 crore is the revenue target that you had shared earlier. Does that remain on track?
Yes, definitely. I'm confident that because all these plants will come in the stream and next financial, that is 2028 end financial year, definitely we should be in a position to reach 3,000 crores if the prices goes like this.
Okay, so 3,000 crore revenue target for FY28 also continues to remain intact, along with the 10 to 15% volume growth guidance that you shared for FY27. Let's also talk about margins then. And raw material prices for you have risen on account of West Asia crisis. How much has the increase been? How much has been passed on? And any impact on margins that you're experiencing at this point in time?
If you see the last quarter and this quarter, both the quarters are similar margins you have seen. That means this is sustainable. Maybe 1 or 2% here and there, the coming quarters, definitely going forward, we'll be doing the same margins. And passing on, it has already happened because it's almost 4 to 5 months. We already started passing on to the customers. First 1 month, we could not do that. But after finishing this raw material stocks, what we were having in the pipeline, then we are forced to pass on the increases to the customers.
Okay, Mr. Reddy, one last question before we let you go. And I wanted to talk about your hotel business because it's just a small pie of the total revenue. Are you looking to divest it? Does it fit in your total strategic roadmap of the company? And what's the outlook looking like for the hotel business?
For the divestment, not yet very decision taken. Definitely, we want to keep that within our portfolio because now it has started giving from last 2-3 years started giving the supporting to the bottom line to the main balance sheet. So definitely going forward, we are aware that the hotel industry, hospitality industry is doing well across the world. So we think that it's good for keeping it within the company only.
Okay, so that's as far as the hotel business is concerned. You did talk about your specialty chemicals business as well, the subsidiary and the outlook on margins for the next few quarters. Mr. Reddy, thank you so much for taking your time out and joining us here on ET Now.
Thank you. Thank you.
And with that, it's a wrap on this edition of the show. Thanks so much for tuning in. Buy now, sell now will come up next.